Welcome to Power Charting for July 16th, 2021. We are going to have a chart fest and talk about a number of different, and hopefully you find these charts as interesting as I have. And we're going to put that into the context of the end of the second quarter. Now that we're in mid-July, we're into the very beginning of earnings season for reporting for the second quarter of the year. And earnings are going to be sizzling hot. They're going to be very strong across many different industry groups, stocks, etc. And is that a good thing? And let's have a discussion about that and talk really more about tactics. We're not going to get into the nitty gritty about individual earnings reports or such. We are going to talk about the impact of earnings on the end of quarter phenomenon. I've gone back 150 years and looked at quarter end data, quarter end phenomenon in the stock market, and have seen that important tops, bottoms, intermediate term, long term have occurred into quarter ends. And so if we're aware of that and the tendency of earnings to influence institutional investors, getting them to rush into the market or rush out of the market into the important lows, it can help to explain a lot about the extension of trends, so to speak. So let's talk about that today. In terms of actual earnings, I would encourage you to check out fellow blogger and really exceptional earnings analyst, and that is Tom Boley, who is right here at StockCharts.com. Go check out his blog and his videos because he just does a fabulous job on earnings reports and earnings surprises. So looking at this cartoon on the left, you can see here that there's the national prosperity, and we've looked at this cartoon a number of times, but you can see that the national prosperity, which is really the economy, is way behind the Wall Street stock market boom. And so this boom is basically the stock market bounding ahead, well ahead of the economy, meaning that they're really out of sync with each other. When the stock market is having a big run, sizzling run higher, typically what will happen is that the economy will follow that, but the economy will come along later and will report earnings and report GDP and so on. GDP is going to be very hot in the second quarter of this year. Well, a year ago was horrible. And so, as we know, in the post-COVID period of the second quarter of 2020. So now we're in a Wall Street stock boom, so to speak. And now the economy is starting to report numbers that reflect why the stock market was in such a boom. And so, and also we can see our investor here, our individual investor, as he runs up to the top of the peak of the mountain, being chased by these fierce bulls. And so we're running up into the highs. Looks a little like a climax to me. Okay, I want to say a special thanks to Andrew Cardwell for joining us last week. We had a blast. Thanks to all of you for your great comments regarding Andrew and what we talked about. Well, I'm going to extend that discussion from last week to this week. Also, I'd like to just remind you that we have the Wyckoff market discussions, Roman and I, and we have these discussions every Wednesday afternoon from 3 to 4:30 on WyckoffAnalytics.com. And this is really a great time. We talk about current market conditions and so on. Had a great discussion yesterday. I'm recording this on Thursday. But anyway, come check us out sometime. Very soon, keep an eye out. Very soon, we're going to have a complimentary episode for you to attend. Okay, so let's, the reason I bring that up is because here is a great chart, and this chart was put together by Roman. This is the NASDAQ 100 E-mini futures, and this is the COVID 2020 accumulation structure back in early 2020. So we know that a cause will be built before there's an effect, which is higher prices. And here we can see this count, and the count is 14.4, 15.4 to 16.1. And so this is from a count line at around 7,200. That's phenomenal. So look at how the point and figure analysis gave us this phenomenal count objective that went up to the area. It's actually more than a double and took us up to this 15.4 plus area. Then reaccumulation formed August, September to the end of the year. I think it was actually November, where this reaccumulation count formed, and this gave us a reconfirming count 15.8 to 16.7. So here we had the conditions for an important advance. And so, and then reconfirmed that advance with a reaccumulation structure. So we showed this chart back in January of 2021. We actually showed this accumulation and others back in 2020 when they were just completing. So very, very powerful and useful tools. Let me add to that with the NASDAQ 100. This is the cash index. And here you can see this count, which is really the period in May. I'll show you a bigger chart of this in just a minute. But this larger count went up to the area of 15,040 to 15, call it 15,200, and very close to the minimum count objective that we had here from this these larger counts. And this, by the way, is daily data. And here we're looking at 15-minute intraday data, but still very useful for, call it, swing trading count objectives. And there's just no other tool quite like point and figure for creating count objectives, price objectives from a base count. And we always like to look for a cause that leads to an effect. And here we have a beautiful cause that forms, and this count line is at 13,138, counting up to 2,000 points higher in the NASDAQ 100. Well, as of yesterday, the high was 15,002, so not too far from this 15,040 count, which is pretty close to being a hit and fulfilling that objective. Could go 15,197, could go through the top of that even. It's happened many times before, but this is so far working out beautifully as a tactical count objective. Now let's move to the bullish percent indicator, which we were talking about these last week. And I want to focus really on the NASDAQ 100 as a phenomenon here, because getting back to this whole idea of earnings, look here, we start the second quarter, literally the low is made in mid-March. Remember, I had stated that the important lows and highs often form around 3 weeks plus or minus the end of a quarter. So this is actually pretty close to 3 weeks prior to the end of the quarter, which came right here. And so you have an important low and then a big rally in the NASDAQ 100. Now the NASDAQ 100 is important because it is the dominated by the capitalization of these mega cap companies, the really the FANG stocks, Facebook, Apple, Amazon, Google, and so on, and some that are just below that, like NVIDIA, and so on. Well, these stocks are so dominant that they completely control the trend of this very large NASDAQ 100 index. The top 100 companies in the NASDAQ is really influenced deeply by, the top 5 to 10 names. So here you can see that this is pretty strong. It's right in the area of 80, which means that for the bullish percent, that means that nearly 80%. Now, this is the NASDAQ 100 stocks, nearly 80% of them are on bullish percent buy signals. And so now, but look what's happening is that we're seeing here that it's starting to turn down. And as you know from prior conversations, that I'm always looking at the directionality of this indicator in addition to divergent characteristics. So as long as the line's going up from even the mid-level, then I consider this to be a favorable environment to be trading this underlying index. But if the line is going down, that means that the weight of these stocks is starting to no longer contribute to the bullish percent data, and also shows that they are stopping their uptrends, etc. Well, here's a look at the NASDAQ Composite. This is all the NASDAQ stocks, and here, a little different picture. So here we have a peak back in February, and we have a big decline after this drop off here. And you can see again, directionality plays a very important role here, but look what's happening to the directionality now. The NASDAQ comp, which I think is influenced again by these very large cap names, is holding up here, but the bullish percent index is basically one stock, one vote. It is a breadth indicator. So this tells us what the average stock is doing. Is the average stock going up or going down? And so here among all NASDAQ composite stocks, the line is dropping, which means that it's an unfavorable or a ever less favorable environment for stocks. This is the NASDAQ comp AD line. Again, it's a breadth indicator, one stock, one vote, so to speak. And you can see here, very interesting is that we have, since February, we have a rising trend. This is largely dominated by these mega cap trillion-dollar companies, lower highs in the average NASDAQ comp AD oscillator. So this is a 5-period moving average, just to smooth it a little bit. But look, the line is dropping here and here, and it's getting into a pretty oversold condition, but it can stay that way or could keep going. Again, directionality is important with an indicator like this. But also the other thing I want to just showcase here is this diagonal triangle. So this is a rising trend where you have two trend lines converging on each other. This often happens when you have exhaustion in the market. So converging diagonal type triangle is an interesting phenomenon. And if it doesn't just break out and start to accelerate, you have to really be on your toes, because oftentimes these can resolve themselves into a pretty sharp reaction, and they generally can go down to the area of this low here. So this is possible for a correction. I just really wanted you to see that. And now let's turn our attention to the S&P, because I'm going to come back to the NASDAQ here in a minute. But again, here is the, let's put up our, so you can see the S&P. These are the 500 S&P stocks, which has mostly New York listed stocks, but also has the super big NASDAQ 100 type stocks in it. And so here you can see this downward stride of the bullish percent for the S&P 500 index while the index itself is going up. I think this is because the very large cap names continue to dominate the calculation of the index itself. And so you have the typical average stock starting to go down from a high level. 85% is very, very bullish, but it's going down. It's to 65. And while this is heading higher, the index itself, this is a non-confirmation of the upward trend. Again, a breadth indicator. Looking at the S&P 500, this is 30-minute data and one box reversal scaling using ATR. And this is a count that I took for the S&P back in May. This is this area. Sorry that I don't have a more detailed, but it's just this area right in here. And so that area is the count that I took intraday, beautiful accumulation type count, and this count here, and up it goes, counts up to 4280 to 4378, and we just reached an intraday high on the 14th, 4393.68. 4394 was a high, which is above the 4378 high objective for the range here. And so this is interesting. We fulfilled this count. Now this is a short-term swing trading count. This isn't the a mega bull count, so to speak. It just says that since May, this advance since May has been fulfilled. These counts were all taken also, and those counts have all been really great and have worked out nicely. But here I'm just showing this count and we've fulfilled it. That may produce some kind of a pause or maybe even some kind of a reaction of sorts. We'll see if a distribution count can get formed. Well, we have one in the New York Composite. Now, the New York Composite's interesting. I like to look at this because it's a little different than looking at the S&P 500. This is all the stocks in the New York Stock Exchange. And here, if we go over here, we can see, look what's happening. Since the beginning of 2021, series of lower highs, divergent characteristics from a very high reading at 80, above 80, and so you have ever lower highs. Well, divergences can form and be in place for a long time. That just means the market is becoming more narrow. It's becoming more focused on these important names that are rallying. The institutions are diminishing their focus to the names that are working best, working hardest, which tend to be the biggest stocks. And that's the reason why you can get divergent characteristics. It's not reason enough in itself to become bearish on the market. But the one thing I want to point out is this is starting to accelerate. And so the average New York Stock Exchange stock is starting to no longer participate in the bullish percent data. And so there's fewer and fewer stocks that are on bullish percent buy signals in the database. But the index itself, here's the S&P, this over here is the New York Composite, but it's rising. And in the case of the New York Stock Exchange Composite Index, symbol $NYA, we have a range-bound condition. This is the month of May here. And since this time, the New York Composite, while this has been weakening, has gone sideways. And so different story, different picture from the NYA to the S&P 500, which keeps going up. Well, let's look at a count here. So across this area of 16,650 on the index, it counts down to 15,050. And so, and we could take a larger count here, but we won't do that yet. we'll take this one bite at a time. This would not completely correct the advance that we've seen in 2021, but it could take back part of it. And so that's something for us to be really aware of. Finally, I want to look at the McClellan Summation Index. This on the left is the NYA. This is the New York Stock Exchange. And this is advancers and decliners. I really like the summation because I like to look at the directionality of it. So if it's going up, that's bullish. If it's going down, that's caution, possibly bearish, low declining prices. And so you can see here how this works. Well, look what we have. Really, since the beginning of the year, this has been in a divergent characteristic. In and of itself, it didn't stop the advance, but notice now that the summation is declining. And so that makes us cautious. And then over here, NASDAQ Composite is the McClellan Summation on the NASDAQ Composite is going downward. And it is at the midpoint right there, the zero line. And so it's actually maybe weaker arguably than the New York, but it is pointing down and it's at the neutral place. So again, just go back and study this and look at the directionality up and down. It's a great tool for that. Here is the Dow Jones Industrial Average on the left. This is just a swing trading one box reversal point figure count. Go 100 point scaling. And so this count, just to give you an idea how much potential there could be in any kind of a drop here, if we just take this green area, 22 columns, goes down to 32,800. So this is just, normal correction type kind of stuff. But also we could get a breakout and a backup and then start to go up again. So we're right at that area. We're right in the danger zone. So this will be very interesting to watch. Now, an index that has not really participated at all is the Russell 2000. Since the beginning of the year, after having a really tremendous advance, it's basically gone sideways in 2021. And you can see here that this count is a much bigger percentage decline. 232 is the high, counts down to 172. So this has more risk in it from here, if in fact, and you can see there's some weakness that's starting to show up in the Russell here, but it's a point of vulnerability. So anyway, just keep that in mind. Now, I'm going to go through this really quickly, but this is the NASDAQ 100. We just talked about why this is potentially leading because of the super mega cap trillion-dollar names and how they're leading and skewing the index. Here is the percent of stocks above their 200-day as a definition of an uptrend. And you can see here that since February, a peak is in, and you can see this decline. Now, this is all of the NASDAQ stocks, NASDAQ Composite stocks, and their percent. It's a breadth indicator. Every stock, it's one vote, no market cap. And so downward it goes, but look here. Now it's actually starting to decline. It's at an even 50% right now, which means half the stocks are above their 200-day, half are below. Market could rally nicely off of this, but the trend is down. We want to see divergent characteristics. We had those, so to speak, here. Look at the line going up as a final test occurred and the rally started. We don't have that yet. Okay, so now this is something that I think is so interesting right now. I have about almost 5 minutes to talk about this. Here's the NASDAQ 100. We talked about that. Here is the ARK Innovation Fund, which we've talked about from time to time. The ARK Innovation Fund does not look like the NASDAQ 100, but the stocks that are in the ARK Innovation Fund are considered to be disruptive, high growth, very dynamic companies. This portfolio is run by Kathy Wood. She does a terrific job of selecting stocks she had in the past. This, I'm going to argue, is not, this decline here is really the product of the market. It's very difficult for portfolio managers to be able to overcome the trend of the market when it's down. And so this is more a product of the market. So here you can see this rally. Look at this, right up to the area of resistance, and look at this climactic surge with a gap right into the resistance area, and now it's correcting again. This is going on while the NASDAQ 100 has been making higher lows and then marching upward to new highs right into the end of the quarter. So institutions, I think, have just been pouring money into these favored names, these very large cap names, right into the end of the quarter. And this is what has extended this upward trend in the NASDAQ 100. A little also occurring, look at that, right into the end of the quarter. There's a peak right there in the ARK funds, but it's nowhere near its prior highs. So now let's turn our attention in the time that we have left. We just looked at this chart here a minute ago, but now this is so interesting. Here is the NASDAQ stocks above their 200-day. Notice the correlation between this NASDAQ stocks above their 200-day, unweighted. This is just looking at pure trends, uptrend above 200, downtrend below the 200-day for each individual stocks, counted up and put into an index. Here's the ARK fund. Now, look what's happened. This indicator and the ARK fund made a high in the 80% here for the percent of stocks here back in February, and then look at this decline. So this decline has just been persistent all the way into May. We counted the point figure counts in May for a rally. Well, this decline coincided with the decline in the ARK fund. And this is an important correlation that's occurring here, and very close. And then you have a rally. So this rally, look what happens. We have a peak here in early June and a test of the peak on this indicator, the 200 days here. And this is the end of the advance so far, and now it's starting to show weakness again. And look at the 200-day index, just is going down. It's to the prior lows. It's really falling quite easily, which means the typical stock in the NASDAQ Composite is basically in a downward stride and at a pretty fast clip. Now, last thing I'm going to show you here, and I have a minute left, so I'm not going to do this justice. Maybe I'll come back to it next week, is here you can see this, and this was inspired by Roman Bogomazov, and we talked about this yesterday in our Wyckoff market discussion, but look at this correlation. This is the ARK fund currently February high. We just looked at that to the present. And here is the NASDAQ comp back in 1999, 2000, and here is the peak and the decline. Look at these correlations. I'm just going to let you screen capture this and look at these peaks here, and I believe this peak might be this one right here. And then following that, this was the big decline in the comp. And with that, we'll come back and talk more about this next time. I am out of time for now. I'm Bruce Frazier. I greatly appreciate your time today, and we will see you next week.